Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. I want to thank everybody for coming in this week and listening to what I have to say about the markets. There's a lot of people you can listen to about the markets. Everybody's got an opinion. I'm trying to keep my opinions to a minimum because the reality is what I think about is going to happen in the market. It really doesn't matter. It doesn't matter what anybody thinks. All that matters is what is actually happening. And the truth is, all you need to know, all you need to really know is what is on this chart, and that'll tell you everything you need to know about what's happening in the markets. Again, there's billions and billions and billions of dollars being traded in the markets every day, and this is what moves the market up and down. It's not, if you listen to CNBC, they'll say the market was up today on news that blah, 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 blah. Well, news does cause fluctuation, but really what's causing the markets to move is just the tug of war between buyers and sellers, and what they see is value and the opportunity to make money either in the positive direction from value or the negative direction from value. So that's really all there is to it. I mean, there's really none of this other stuff really matters. I think the Fed does matter. Mainly, it matters because all these people with all this money think it matters. And I know that's a little, it almost sounds kind of jaded, but that's kind of the way it is. I mean, nobody can know everything there is to know. So the nice thing about looking at something like technical analysis is this movement, these bars, the higher highs and the lower lows and all this stuff really tells you a lot about what participants are doing. What people say doesn't really matter. What they do matters a great deal. So that's why we focus on the chart. The chart tells us what they're doing, not what they're saying. If Warren Buffett comes out and says something, great, but what Warren Buffett does may be a totally different animal. And so we want to focus on what is actually happening, not what people are saying about what is happening. Having said that, I'm talking about what is happening, but I'm using the charts to do so, and that's the difference. So we had an up week, as you can see here. I quit whipping this thing around on you. We finished the week at 2102.06. You can see here that this was the low right there. That was the most recent low. Although we had this range kind of staked out between 2119.60 and 2044. This low is actually a little bit lower than that, and you can see here the high for that low week was right there. So you can see that we actually closed above this high, which likely means, which the probability of exists that this market will extend into this level of support, this level of resistance, and might actually go above this trend line. We'll just have to see. It really only needs to get above this 2120 area, and then it could roll over. But the things I want to say about this particular pattern is it's a rising wedge type pattern. These are typically trend terminating patterns, okay? Now, this is a very long trend, and this particular pattern is very short. So it's really only terminating this trend. But if you do break this lower trend line, the tendency is for the pattern to just completely get wiped out. So this is where the pattern begins. You can see it. It's here, 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 here. Let's kind of say here. And it should end somewhere up here, let's say. So when it breaks down through here, it usually almost always will sell off all the way, or it can go in either direction, but it will always go to the beginning, to the origin of the pattern. Okay, that's the technical analysis. Does it mean it absolutely has to do that? No, that's not what it means. But if you're looking at trading, for example, and you break out of this this lower trend line, what you would do is you would trade. You would say, okay, if I broke out of this lower trend line, like this, my target is right there. Now, and what you would do is you would watch it. So the stock would go up, it would go down, it would go up, it would go down, it would go up, it would go down, and you would look for, lower lows and lower highs until it went. Now, if it did this, if it made a new high, or if it took out a previous high, you would have to say, well, that's it. That's where I'm stopping out. You're not going to make it to this. That's what I mean by it doesn't have to go down there. Let's look at the volatility, since we just looked at the S&P 500. Volatility, I drew a new, what you'll notice on here is I drew a new trend line, this blue line here, because we've had a number of excursions now outside of the green line, and again, this is just a judgment call, but to me, the green line is no longer holding, and it's time to give up on that, at least for the time being. Since the market is likely to continue higher into resistance, I think you're going to see even a lower low than this low in volatility. Now, we might get a candle next week, like right here, something like this. And then the following week, we might get a candle that looks like, like this with a tail on it. So the volatility went lower, but then reversed. And then then maybe the following week, you get a candle that looks like this where volatility is starting to expand. And then maybe you get a big one like this. Okay, and volatility can expand pretty rapidly, so it could get, you could see some of these candles are pretty big. So, we might get an increase in volatility a little bit. The market might pull back a little bit, and then resume higher, which means volatility will come lower, and then take off maybe to the upside. That's all speculation. I have no idea. It's just something I'm looking for, so that if it happens, I have some trade setups that I can launch. That's the only reason I look at it that way, is just to try to have some plan going into the next week of what to expect. Japan, we've talked about Japan. It was in this trading range for the longest time. It broke out of the trading range. We're expecting Japan to move up into this resistance area. Now, it could pull back first and then move up into the resistance area. That's always a possibility. But that's working out very nicely. I didn't trade anything in Japan. I'm not trading really anything in any of these countries that are doing crazy, except the U.S., that are doing crazy, things with the currency. Japan's just, they've lost their minds over there. They've printed so many yen, it's just insane. But that's just my personal thing. I'm not going to get involved in that because it can be manipulated so easily. Germany, one of the things you're seeing in Germany, because the euro is losing so much value, and the German DAX, for example, is denominated in euro. You've got the euro lifting, so it's just continuing to do that. The reason it's not happening that way in the FTSE, if you look at United Kingdom here, it's because the United Kingdom is in British pound, and it's not taking a beating like the euro is. It's not doing that great either, but it's not taking a beating. And I think you'll see the British pound move up into this area and then roll over and come down. That's what I'm expecting to happen. It might get a little higher than this actually, but I think it'll at least make it up to this resistance area around the 62% retracement. That's what I'm looking for to happen there. Looking at the euro, again, the euro is just, I mean, it's crazy how bad this thing's selling off, but looks like it's going to make a lower low. We put this line in a while back. I'll show you why I did it. I think I got to go back 20 years. Yeah. So you had this low way back here in 1997 that I kind of picked. And then I came across right through here through this congestion area. So there's a congestion area here. And then you got a low here. And, didn't quite come down and retest that low. So to me, my eyes just kind of landed on this line through here. And oddly enough, the market, it came right down and touched that line and then bounced. But I think what you're probably going to see in the euro is probably something down into this 95 area. And it could come all the way down into the 85 area. I mean, ultimately it could make a new low, but this is very, there's what's the word here? There's hardly any trading right here. I mean, you're talking about, these are tails, you don't have a lot of, I don't know how to explain it. There's very little volume here. There's not much trading activity that took place here, so you're not likely to see many more sellers at that point. So maybe this somewhere between 85 and 90 on the euro, and then you get a really big bounce probably. So I don't know. We'll just see. It could stop here. I mean, it could. Although we're, the MACD, the internals were rolling over pretty heavily. So, but I mean, it's just crazy. I mean, every country in the world, even the U.S. I mean, we're not printing money right now, but that doesn't mean we couldn't start back up. Somehow we've convinced ourselves that more money in the economy somehow makes us more wealthy. But if you really think about it, that there's no logic to that, because really what makes us wealthy is production. And if you just have more money in the economy, but you're not producing anything more, all that means is what you are producing is just takes more dollars to buy it. That's all it really means. So it doesn't really do anything to what it does do is it allows the people that get to use it first. So if I'm the one printing it, it's just like, think of it like counterfeiting. If you're a counterfeiter and you're a good one, you can print up $100 bills and then you can go spend them. And effectively, you're increasing the money supply, so that causes inflation. But because you get to spend them first, you get the most value out of it. That's essentially what happens with the government. The government gets to spend the money first, and so therefore it gets the most bang for the buck. And then it gets to turn around and pay the borrowed money off in the future with dollars that are worth less. So that's basically the game that the government plays. And the reason they play the game is because we have politicians run around promise people stuff that we can't really afford. And so this is what you have to do in order to fulfill on all those promises. You have to take from everybody a little bit at a time in the form of inflation in order to pay off debts in the future with less dollars, and in order to get the most value out of the money that's hot off the printing press. So that's the game. It's not a very good game. It's not good for the average American. And arguably, I don't know that it's good for any American, at all. So let's look at the 10-year interest rate. This is, I wanted to. Wow, that's a very long chart. Let's not go back quite that far. Let's go to a 5-year. Larry Summers, for those of you who don't know who Larry Summers is, he was in the news this week. He was the former Treasury Secretary under Clinton, and he was commenting about this particular week right there. And he was talking about liquidity and how, I think he called this a 7 or 8 standard deviation move. It was actually about a 3.5 standard deviation move. But these outlier moves like this, they create liquidity issues because they just, in short, because of the way our banking system is, it's a leveraged system. So, in other words, for every dollar deposited, the banks get to create, $9, $10, let's say, and that potentially can create liquidity issues because if the banks had that money tied up in mortgages or other assets and depositors come for their money, then it creates liquidity issue. That's why they say they need the Fed. The Fed needs to be there for the lender of last resort. The same thing happens in the bond market. People get stuck on the wrong side of these trades. They have to sell because their accounts get below a certain value or there's certain margin levels in their accounts. So they have to sell things. They have to do things they don't want to do because they don't have enough liquidity. They don't have enough money, extra money laying around to handle the losses. So they have to sell something in order to pay somebody off somewhere else. And of course, we wouldn't have these liquidity issues if we just didn't have so much leverage in our banking system. That's really the moral of the story. But you won't hear any of them say that. They just talk about how they need more liquidity. Let's just print some more money so that we have money laying around in case we need to, in case there's a panic in the market, we won't have to sell anything to deal with the panic. Well, again, you and I don't get to do that. I mean, why should the banks get to do that? Why should the Fed, privilege the banks with such a privilege that works against the rest of us? I mean, I don't know. It just doesn't make any sense to me. Maybe it makes some sense to you. If it makes sense to you, please comment and explain to me. Maybe I'm just not understanding something, but it's very difficult for me to see any rationale in that. All right, let's look at the U.S. dollar. The U.S. dollar, I don't know. We might not get the pullback that I was looking for in the U.S. dollar. I was looking for the U.S. dollar to pull back into this area, potentially even lower, maybe even into this area, the 91 area. But this was a pretty strong move this week. I mean, you can see here on the Williams, it had started to move into this direction here and then reversed. Now, sometimes you can see, like in this case, it reversed and then it stayed overbought for a long time. I mean, look at this run. But sometimes it'll do this and then roll over immediately and come back down and get into this area. So I don't, who knows? I mean, I could show you. We could look at some different scenarios, but bottom line is the dollar's, it's pretty overbought. It probably needs some sort of rest. I was anticipating the rest would come as deep as this, the 91, 92 area. I don't know. It's not at this point. It's not looking like we're going to get that. So we'll see. That could have some implications on where we want to get in, where I want to get into gold. I mean, if at this point it takes out this high, and that's probably not going to want. I'm probably not going to want to get into gold for a trade like I thought I would. So we'll just have to see how it turns out. Let's look at NinjaTrader. We'll look at the DAX. You can see here the DAX is very, very strong. Just like we were saying, if you look at the Euro US dollar, where is that? Euro US dollar. this is the reason the DAX looks like that. I mean, can you see that those are, when there was, as much as that one's up, that one's down. So, in order to buy, you need more, the euro's losing money, so you have to, it causes the asset values to go up. So the DAX is made up of nothing but companies which own assets, and so the value, the nominal value of the DAX goes up. The real value of the DAX is probably flat or down, but you would need something that measures inflation, or here in the U.S. we have the Elliott Wave tracks something called the Dow PPI. So it's the Dow Jones Industrial Average divided by the Producer Price Index. And those are really interesting charts. I mean, it really makes it really gives you a sense of the difference between nominal value and real value. And that's kind of the situation you have with the DAX. I hope that was clear. Here's gold. I'm looking for gold. If it pulls back into this area, I probably want to be long gold, unless the dollar is really taking out that new high. So we'll just have to see how that goes. If the gold pulls back here, and I go over to this dollar chart, and the dollar is not at a new high, it's not above this area here, then I'll probably buy gold. If the dollar is still below this high, and gold's at support, I'll probably buy gold. So we'll just have to see how that works. And I mainly want to buy it as an engagement tool for this YouTube channel, so that we can, we talked a couple of weeks ago about this pullback and how there was no higher high, on any of these pullbacks, and how this one was different, and you could have bought right here on this week right here. See what I mean is this high is lower than this high is lower than this high is lower than this high. Now this one's a little bit higher, but you can see the close didn't close above that. The close didn't close above this. This close didn't close above that. This close didn't close above that, and so on and so forth. The only time where you get a low, okay, so here's a low, and here you had a close. See, the close is right there, and it's above this high right here. So this is an entry, okay? And my point, going back to why I wanted to buy the GLD, is just to show you over time how this methodology, now it doesn't work every time, but it works the majority of the time. And if you do this close to support and trade to resistance, the risk to reward will always be significant. So in this case, your risk is, say, from here to here, okay? But your reward is, say, from here to here. And you can see that this gap right here, this reward, is much, much greater than this risk. And if you can set up your trades in such a way that you have this kind of scenario, you'll make money over time. You'll be wrong, but you'll be wrong this amount. And when you're right, you'll be right this amount. Whoops. So wrong, right. You can see just visually the difference there. And yeah, if you're wrong 90% of the time, you would lose money under this scenario. But what happens is you're wrong only like 30 or 40% of the time at the most, following some methodology like this. Okay? Hope that's clear. If it's not clear, I'll probably cover it again as we enter some trades. And I did enter an SPY trade, and I'll show you that in a minute. See what else I want to look at here. Let's look at oil. We're looking for oil to move up into this this resistance area. at some point, and maybe oil's through going down. You could get, there's a resistance area basically right where we are, so you could see oil move a little bit higher from here and then roll down and make a lower low, and then come up to here, okay, like so, like this. In fact, I think there's still a very high probability of that, because this whole move right here this move right here from this low to this low, this looks kind of puny compared to the move down here. Normally, if you look at this distance here, this distance from here to here, I don't know what that is. That's 91.85 to 110. So let's just call it, I don't know, $10. Well, the move from here from 43.45 to here, I don't know, that's $10 also, I guess. Is it $10? Let's see. 110.20 to 90. No, that's $20, okay? But here we only had from high to low, from this low right here to this high right here is only $10. So a lot of times this move here, this first move down, is about equal to this move here. So what that tells me is that oil could go a little higher here and then actually make a lower low and then go higher until you get like a $20 delta between these moves. That's a little bit confusing, and maybe I'll cover it another time, but basically what I'm saying is this move here, the move from here to here, is generally more equal to this move from here to here. Okay, so we made a lower low here. So normally what you would expect is you expect to move from here to here and then a lower low. But we could get, this could be something that looks like this, and then we get a lower low, okay? And then a big bounce from there that would take us up into the 75 area. So all I'm saying is, I'm not sure that is the recent low before we come up here. I mean, I'm not sure that is the low before we test this area. There may be a new low that's going to be printed, and then we'll test this area. And that's part of what you don't know. There's no way to know that, so you just have to have some rules about where you say, hey, I'm wrong. I just was wrong on that. All right, let's go back over to this, and I want to show you that an instrument that we're going to be talking about here in a second called the SPY is an instrument for the S&P 500. It trades like a stock. It's a very good instrument. It's very diversified because it's based on the S&P 500. So it's kind of like indexing. It's very similar to indexing. So I want to point out to you that today, well, let me pull up a daily chart. So you can see that today was up 0.52% on the index, on the SPX, okay? Now, if I put in the SPY, okay, notice that the SPY was up 0.55. So the SPY and the SPX track each other almost perfectly. Not quite perfectly, but almost perfectly, which makes it a good indexing tool. So what I did is I entered a trade back here on April 8th. I could have done it earlier, but I didn't. I was waiting we had a pretty strong up day here. I was waiting for a pullback. We didn't get as much pullback as I was hoping for, so I just went ahead and entered there. Now, the SPY, where I entered the trade, and let's just go look at it. I entered the trade at on April 8th at 11:25, okay? And what I did is I sold some puts. So this says 205 strike puts, and I sold 5. Now that's like controlling 500 shares of stock. That's kind of like, it's almost like buying 500 shares of stock, but it's not quite like buying, because all of this price here that I sold it for is all time premium. So when you're dealing with options, there's two parts to an option. There's what's called intrinsic value, and then there's extrinsic value. So real quick, let's go over to the options tab, and let's just look at let's kind of look at the 205 area. Okay, so here are the 205s. These are the 205 puts right here. Okay. The different prices, there's always two prices in the market. There's the bid, which is the lower number, and then there's the ask. So the difference between them is called the spread. And so what I did is I sold, you know what, I must be looking at the wrong strike. Because I think it said 76 cents. It didn't say $1.50. So let me I don't understand why I must be on the wrong month. Let me go back and see what I sold. Oh, I think I sold a weekly. Let me look at that. Sorry about the confusion here. Maybe I sold those. No position on that. Where does it show? Oh, here it is up here. So I've only got 20 days left in the option I did. Okay, so sorry about that, guys. I just was on the wrong option chain. So what I sold, here's the 205. So let me zoom in on this real quick. So I sold the 205s at the time in this column for $1.67 or something like that. And currently, the price in between here is 76 cents. So theoretically, I could buy them back for 76 cents, on Monday. Now, again, there's two prices. There's the bid and the ask. So if you're buying, you're buying at the ask, and if you're selling at the bid, or some number in between these. The difference between these is called the spread. So what I did was I sold what's called an out-of-the-money put. Okay. Now, right now, let me go back out of this real quick. Right now, the stock is trading for $210.19. Okay. So what does that mean? That means that, oops, sorry about that. That means that if I'm looking at this option right here, this $210 option, that means 19 cents. If I was to buy that, that means there's almost $1.80 in premium. Okay. So if I bought it, yeah, that's true. If the market went up, this would go up in value. This number right here would go up in value. But there's a time element to it. So the thing's losing time. So if you had a, think of it like this, you got an axis. Okay, so time is here. Okay, and dollars are here. Sorry about this, it's kind of crude. Dollars are here. What's happening to the option is oops, I did that backwards. Let me erase that. No, that's right. I did that right. So the value of the option, as time increases, the premium is higher. So what happens is as time goes to 0, so here's 0, and here's, I don't know, let's call it 40 days. Okay? So as you go from 40 days to 0, what happens is the value of the option goes to 0. So that at expiration, the option is actually worth 0. So what's happening here is if I bought this option, almost $1.80 of what I'm buying is premium, and about 20 cents of it is value. Or think of it like equity in your home. So out of the value, out of the price of this option, think of it like $1.80 of it's interest, and 20 cents is principal. Okay. So when you sell an option, it's the same thing. You're selling. If I'm selling this option right here, $1.80 or so of it is premium. It's actually not related to the value of the instrument. It's just a cost. Think of it as cost of doing business. So you can sell this premium by selling options, or you can own this premium and hope that the stock goes up and that you outpace the premium, the loss in premium, because your premium is going down over time. You can, if the stock moves in your favor, then it's gaining value. You can see these as you go down here. These are all gaining value, and so the premium, the option has more and more intrinsic value and less extrinsic value. I know think of it in like a house, equity in your house, or principal. How much of your house do you own? It's the same way with options. The difference is you can be a seller of options and sell time premium. And this is actually a very good way to make money in options. So I think that's where I'm just going to leave it for now. But I could have bought an option on the SPY, but I ended up selling an option because, and I'll tell you why I did it. Okay, I'll tell you why I sold an option instead of buying the option, and that's because, see how this is almost like in a trading range here? There's just, everything was just kind of mumbo jumbo here in the middle. You didn't have a good trending situation like you have in this area. If you had a good trending situation like you had in this area, you would just buy the option, because the premium, you would blow right through that, and you'd make a lot more money by just buying the option. But here, selling the option, if the market's just chopping around, selling the option is a better deal. This is why I sold the option. It could be that this trend gets a little stronger, but in my opinion, it's not likely. So I sold the option. If you go back and look at when you have a really sharp pullback like this one, this is a real sharp pullback. Usually the snapback trend is pretty strong. Here's another one, sharp pullback, snapback trend is almost straight up. But if you look here, we didn't really have a strong, we had this was a pretty strong pullback, and we had a pretty strong trend. But this pullback was strong, and then it just kind of chopped around. You just didn't really, you didn't break this lower moving average. I mean, it was just, none of these pullbacks here were really strong. So these are good times to sell options. Now, if you're breaking hard through the moving averages, this is a good time to go long options and just own the option or own the stock. Owning the option and owning the stock are kind of the same thing, except you have this time premium element in options. So anyway, the reason I did this, getting back to that, is I just thought it would be a good engagement tool. I'm sitting here explaining to you, you get in, you get out. It's easy when I can see the whole chart. Oh, well, you get in here and you get out there, you get in here, you get out there, you get in here. It's easy to do that in retrospect. It's harder to do it in real time. And so the purpose of doing this was to show you that, look, this actually does work. We're going to make money doing it. And we're going to use this as an engagement tool so that you can see, how we're doing here. Are we making money? Are we losing money? And to the extent you want to know about options, I'll explain it. But really, I'm just doing this to keep us all engaged in what we're actually doing. I don't know. I hope that explains it. I just thought it would give it a little bit more value to the conversation than just talking about the chart without keeping score. So this is just a way to keep score. We're probably going to lose. There's going to be some times when we lose money, but on balance, I think we're going to gain money, and we'll show you how to do that. That's really all I want to say about that. I wanted to get into GLD. I missed it. Here's gold. I should have just entered right there at that time. If you remember, mostly we're looking at weekly charts. So if you pull up the weekly chart here, the comment I was making, give it a second here to come up. And my internet connection's kind of slow tonight. Okay, there it goes. So if you recall, we were looking at this pullback here. And we were talking about how there was no close above, it was just a solid pullback. And then the first close was right here, a close above the low day or the low week. And I was talking about you just enter right here, just enter right there, boom, enter. Well, I didn't, and I said I was going to try to see if there was a pullback, back to the trend line for the following week, and there wasn't. It just kept going up and it kept going up. So now I'm looking for a move in, right into this DP area. And if I can get a move into this DP area, I'll be a buyer of gold, and we'll trade gold up probably to this 1350 area is where we're going to look to trade it to. Maybe a little bit beyond that. And that's the plan. So if I can get gold to pull back here to just below 1200, we'll be a buyer on GLD, and that'll be another engagement tool that we'll use here on the YouTube channel. So that's really about it this week, listeners. Really appreciate you coming in. I don't want to keep these too long, but I'm trying to explain certain things. I don't know how much we want to get into options. Really, options are no different than buying or selling stock. It's just you don't have to have as much capital to do it. And it turns out selling options is actually a very profitable thing to do. In fact, most of the people that make money in options they're option sellers. They're not necessarily option buyers. So I don't know. We'll kind of play that by ear. Maybe I'll on the GLD. The problem with the GLD and let me just show you real quick. If I were to buy, let's just say I'm going to buy 100 shares of the SPY. Okay, I click on this. There's 100. You can see 100 shares right here. I hit confirm and send. Well, what do you see? You see, to buy 100 shares costs $21,000. You have to have $21,000. Well, your account might only be $20,000. Let's say it's $100,000. You're spending 20% of your account in one position. That's usually not a good idea anyway. So that's the main reason, I look at options. I mean, it's just necessity. I mean, otherwise you're buying, 10 shares of SPY and you get a 10% move and your stock goes up 3%. I mean, it's hard to make money that way. You can do it. It just takes a long time, and you know to kind of make it work out for yourself. So anyway, that's it for this week, everybody. Look forward to seeing you next week. And if you've got any comments, anything you want to talk about, anything you want me to leave out, certainly tell me. Hey, don't talk about options anymore if you don't want to hear that. Let me know that. No, because I don't want to talk about things that you don't want to talk about. Anyway, that's it this week. Thanks, everybody. Appreciate it. We'll see you next week. Take care.